Welcome to my channel. I'm going to show you step by step how to value a stock. We need to enter the information for the company into my Excel model. At the end, we calculate and look at the financial ratios. We're going to take a look at the Interpublic Group. They're an advertising agency in New York City. Let's get started with the model. The company has a market cap of $7.2 billion. So that's the value of the company according to the stock market. And they're trading at $18.53 a share. And the way you value a company is you estimate the future free cash flows and then you discount that number back to today's value. That's what we're doing in this video. Now I'm pulling their actual free cash flows to put into the model. Let's look at the cash flows for a minute. The way you calculate free cash flow, you start with net income, that's at the top, and then you add back the non-cash items from the income statement. So you can see depreciation and amortization is a common non-cash item that you have to add back. In 2016, they had $600 million of net income and $300 million of free cash flow. So they had less free cash flow than net income. Same thing in 2018, less free cash flow than net income. So I always like to look at the cash flow statement to see why that is. The main reason seems to be accounts receivable. So they made a lot of sales, but they didn't collect the money. When you book accounts receivable, that means you're booking a credit. You're giving somebody a product or service without them paying for it. They're going to pay for it in the future. So they booked $220 million of accounts receivables in 2016, and they booked $603 million of accounts receivable in 2018. So that's money suck. That detracts from your free cash flows when you add accounts receivables. And that's why their free cash flow is below their net income in those 2 years. And you should eventually get the money when the customers pay for their product or service. And you could see in the trailing 12-month number, they had $1 million in the positive direction accounts receivable. So they received a lot of money in the past 12 months. When you look at financial statements, they use accrual accounting. So the stuff you're looking at may be from years ago. So it's really hard to piece things together. Let's look at the income statement to get the net income. That's a profit and loss for the company. And I'll put that into the model. And let's get their sales for each year. That's also on the income statement. Let's take a quick look at the numbers. So everything is positive and fairly consistent. So we should get a good value for the company. And it looks like their margins are decreasing, which isn't good. Because even though their net income is going up, it's going up at a slower rate. In 2016, they converted 8% of their revenue to net income. And in 2019, they converted only 6% of their revenue into net income. So they're becoming less efficient. Let's look at the capital structure so we could get the discount rate. The interest they pay on their debt is $199 million. And the debt they have is on the balance sheet. We'll go to the liability section. And the current debt is $554 million. That's debt due within 12 months. And the long-term debt is $2.7 billion. That's debt due after 12 months. They pay 6% interest on their debt. Interest payments are tax deductible, so let's get their effective tax rate. Income before tax is $878 million. And the income tax is $204 million. So the effective tax rate is 23%. So to get the cost of debt, it's the interest rate on debt, the 6%, times 1 minus the effective tax rate. So the cost of debt is 4.6%. The cost of equity, we need the beta for that. And we'll go back to Yahoo to figure out the beta. And that's how volatile a stock is relative to the market. And the beta is 1.05. So the stock moves pretty much with the market. Let's go to their balance sheet to get their current assets. We need the current assets to calculate the current ratio later. And current assets are assets that can be liquidated into cash within 12 months. So they're the assets that you use to run your day-to-day business. And that's $8.8 billion. Let's see what that is. $1.2 billion of cash, $7.1 billion in net receivables. Net receivables are accounts receivables minus the accounts receivables you don't expect to receive. They have $400 million of other current assets. We need to look on a 10K to see what those are. Let's go to the liability section, get their current liabilities. You also need that number to calculate the current ratio later. That's $9.4 billion. That's $500 million in current debt, $7.2 billion in accounts payable. Accounts payable is what the company owes its creditors and suppliers. $740 million of accrued liabilities. So companies incur expenses throughout the month, but if it doesn't pay those expenses, it adds it to accrued liabilities. And then when it actually pays it, it takes it out of accrued liabilities and then passes it on to the income statement. So payroll is a common type of accrued liability. Deferred revenue is the best liability because this is the revenue the company received, but it has not yet delivered on the product or service. But when it does deliver the product or service, it will take the money out of deferred revenue and book it to revenue on the income statement. Because you can't book revenue until you actually provide the service. That's why they use accrual accounting, so it matches everything up. Other current liabilities is smaller items that we don't know what they are. We'd have to look at the 10K to figure that out. The stockholders' equity is $2.8 billion. That's the total assets minus total liabilities, or the value of the company according to the balance sheet. That's $39 million of common stock, $2.7 billion of retained earnings. And retained earnings is the money the company earned minus the dividends. So it's the money the company can use to grow its business or to pay down debt. They have negative $930 million of accumulated other comprehensive income. These are unrealized losses on some of its securities. When they actually do sell the security, they will have to take the loss and then book it into the income statement. They have $1.1 billion of operating income. That's how much money they earn from their operational business. Let's look at their capital structure. They're 55% debt. Cost of debt is 4.5%. 45% equity. Cost of equity is 10.4%. And the WACC is 7.2%, which is a blend of the cost of debt and cost of equity. That's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimate a terminal value, which is all cash flows past year 4, that's $10.6 billion. Then we had to discount those numbers back to today's dollars using the weighted average cost of capital. We get a value of the company of $11 billion. We need to divide that number by 389 million shares, and we get an intrinsic stock price of $29. It's trading at $18.50, so it's trading at a 36% discount, so it's a buy according to the model. Let's see what Simply Wall Street says. They're a little higher, they're at $32, so they're also saying the stock's a buy. Let's see where it's trading at. So it's been trading in the low 20s for a while, but then it's dropped. Because I think with coronavirus, investors don't see the future of this company so strong. I'm sure after 2021 or whenever coronavirus passes, this company will get back to where it was, but it probably will struggle a little. Let's look at their financial ratios. They have a good PE, a really good price sales, and a good price to book. So PE is stock price over earnings per share. Earnings per share is net income over shares outstanding. And I like to see a PE below 15. They're at 11, so that indicates investors are willing to pay $11 for $1 of earnings. Price of sales of 0.7, that's stock price over sales per share. To get sales per share, that's revenue over shares outstanding. I like to see below 2.5, they're at 0.7. This indicates investors are willing to pay 70 cents for $1 of revenue. Price to book is stock price over book value per share. Book value per share is equity over shares outstanding. I like to see below 3.5, they're at 2.6. This means investors are willing to pay $2.60 for $1 book value. They have a low current ratio, good ROE, and a good interest coverage ratio. Current ratio is current assets over current liabilities, so they're a little shy. ROE is net income over equity, so they provide a good return to the equity holders, 24%. I like to see above 20%. Interest coverage ratio is EBIT over interest expense. They can cover their interest expense 5.5 times. That's really good. And a good way to look at ratios is to compare them to similar companies. I've done videos on Omnicom and WIMI. Interpublic is right here, and if their number's in red, they're worse than the average. If they're in green, they're better than the average. So they're worse than the average in everything except market cap. WIMI is doing really well in most categories, but WIMI is such a small company. It only has 201 million in market cap, so it can be a little risky. I actually did a video on WIMI a month before the stock shot up, saying it was undervalued. That's actually my most watched video. Check it out. Thanks for watching the video. Let me know if you have any questions. Talk to you later.